Welcome to another episode of the Commercial Property Investing Podcast Australia. I'm Arjun, Paliwal, co-host of the show, joined by Chris Huxter, our head of commercial at Investigate Buyers Agency. Now, in a few other episodes you've been tuning in, you've been seeing us with guests, whether it be people from the asset management space, commercial sales, accounting, and more. Once in a while, we just want to catch up on things between Chris and I to talk about the trends we're seeing at Investigate, give you insights on where you may need to be to transition to the world of commercial property, dive into a few concepts even deeper that some of the guests have shared with us so we can help you level up your knowledge. Chris, mate, it's awesome to be on the show here with you again. But this time we get to pick your brain.
Oh, mate, can't wait. Go for it.
Well, Chris, I think the biggest thing we get asked often from the residential segment of our team is when to transition from residential property to commercial property. What are some scenarios where you see that this is the ideal point and why?
Yeah, it depends on the couple's or individual's goals.
Yeah.
And it all relates to having the money, because in commercial investing, you need a significant deposit, as you know, Arj. And if you've built up a residential base, whether it be 2.5, 5 million, 7.5, 10 million, that doesn't matter so much. It does matter in terms of your goals, having that round number and then getting a certain amount of yield from that residential portfolio. But the residential portfolio is really a foundational investment style that we have in Investigate.
And so what you're saying there is like those dollar values, they're like the holding base, as in once you get to these dollar values, it's like their target goal. Is that what you're saying?
Correct.
Yeah,
Correct.
Got it.
Yes. So that's their target goals, right? And then once you transition into commercial, you normally just stick with commercial after that. So as a bare minimum, what you'd want is you'd want a cash deposit or cash holdings of about 600,000. Now I'm not talking about equity, I'm talking about cold hard cash. If you're in a position where you have a significant residential portfolio and that's giving you lots of cash, then I would say use equity so you're neutral.
Yeah, so this is kind of like you deciding whether you have cash that you can deploy, and the big parts of deploying that is that you're not negative cash flow on an asset you're buying for cash flow.
Correct.
Because it's not borrowed against.
That's right.
But then if you're wanting to make that transition and you've got equity and you feel like your portfolio's grown a bit, that even if you re-leverage that equity, it's not like your residential portfolio is going so much back in cash flow that it's hurting you, rather than you trying to save that deposit for commercial, which it's not easy to save 600K smackaroonies, right? So you're trying to move that cash from the actual equity into your commercial property to fulfill that deposit. Is that kind of what you're saying?
Correct. Because when you invest in commercial, you're for the cash flow, right? And if you're pulling it out of your resi base and you're negative overall, well, then what's the purpose of investing in that commercial property in the first place? So we like to have at least 600,000. So say if you're going to purchase a $1.5 to $2 million property, if you're going to go $2 million property, you're going to want 700K.
Yeah. And is that for like deposit costs, things like that?
Yeah, exactly. So it would be, some of it's deposits. I would say about maybe 500K would be deposits. We would like to have about 70,000 to 60,000 in buffer money as well, in case like 6 months gross rent, just in case anything goes wrong with that property, but also your acquisition costs as well, like your stamp duty, your valuation reports, your building reports, your legal fees, your buyer's agency, if you're using a buyer's agent. And yeah, so you need a significant cash.
Yeah, and that's sort of swinging a couple 100K here and there, depending on whether they're getting an 80% loan or a 70% loan or 75%, depending on the lender. So that helps on a transition point in terms of resi. When to summarize there, it's like what you're saying is you want to have a target asset-based goal, 2.5, 5, 7.5, 10. And that could come from buying or holding those assets, compounding there. And then once you get to that goal, you're kind of saying, all right, let me draw the line. This is my long-term wealth generation, long-term equity growth. I leveraged high loan-to-value ratio loans to be able to get that wealth. So now it's printing for me. But then it's like, if I just keep going this avenue, it's kitchens, bathrooms, roofs,
That's right.
roofs, things to think about. It's negative cash flow or not as good cash flow to think about. So it's like, when does that transition point? When's the happy place, right? And so that's that part. Have you seen investors though go, well, I just want to skip that part. I just don't want to do that. Like, what type of investors go, I don't want to transition from residential commercial. I just want to go straight to commercial.
So it's normally people who either A, have their own business and they've bought their house, the principal place of residence, and they've paid that off and they've got significant cash buffers from their business and they have no other debt. We have inheritance money as well, where they've inherited millions of dollars and they want to park that straight into a commercial asset, because typically a normal investor would, or your common investor would, build up their equity base via the residential investment path first. So you got to invest, you got a strong equity base there. But whereas if you have the cash already, you're already getting into that goal of what that common residential investor would be doing already. Right?
So it's almost like, I don't need to play the slow game to build my deposit and eventually come back with equity, or eventually come back when I hit my asset base goal. I've got the cash saved up. I'm in a position to go. And I kind of I always say it like this, like I don't want to go one step back, 2 steps forward. I just want to take 1 step forward.
No, that's right.
And another step forward.
It's more of a passive style of investing as well with commercial property, because when you acquire a commercial asset, everything's taken care of for you. Like the outgoings, the land tax taken care of for you, the management's taken care of for you, repairs and maintenance. So it's a very hands-off investment. Whereas with residential, if you have 7 houses, you're fixing bathrooms, like you said, kitchens here, changing light bulbs there. It's a bit more of an active investment.
Yeah.
So
I'd hope you're not personally doing it. Do you know what I mean? There's a property manager there for a reason. Right. But no, look, it makes sense. And I think as well, people have different headspace capacity. Like there's some people where their businesses are jam-packed, group of companies, hundreds of people to lead, different budgets, invoices, supply payment issues, logistical issues, whatever industry or niche you're in, market, competition, anything. And then on top of that, you've got a healthy cash position. Do you really want to have an extremely negatively geared trophy home? Do you want to have a multiple quantities of properties that kind of have the death by 1,000 cuts? It's that kind of sensible move to go, well, I don't have a diminishing rental return as I go into commercial. The 2 million, the 3, the 5, the 7, I can still get 5, 6 or 7% net yields, even as that, delta on the price keeps rising. So I can totally see where you're coming from there with that type of business owner and professionals kind of going, why would I, go into resi? Let me just skip that and move over. So that actually gives me some insights on cash and positions and, transitioning moments. Loving the show and keen to invest? Well, book your free discovery call and we'll actually walk you through how to build a high growth portfolio without all the guesswork. Just jump onto the link in the show notes or visit investorkit.com.au to book your discovery call. And now let's get back into the show. I want to understand one more thing from you, which is just a bit of we don't have to go through every state, but just some states where the costs aren't as much in terms of getting into a commercial asset and, where they save money when it comes to buying, whether it be stamp duties or other things like that, because that could shift the things on a $2 million asset by an extra $100,000 in terms of cash required. Of course. So where does that happen and how does that work? Yeah,
so 3 states is where it's happening at the moment. So what everyone knows about is South Australia.
Yeah.
It's the most commonly known place where you buy commercial property and stamp duty is exempt. So you're saving upfront costs there. And it's a significant portion. It's about 5%. So big savings there. Anything in ACT or Canberra, anything below 1.9 million, that's also a stamp duty free exemption. So anything above 1.9 mil is just standard stamp duty rules apply.
Yeah.
And now Victoria have come up with a new CRPT starting from last year, July, where you can opt to pay stamp duty or pay a 1% property tax.
Makes sense. Yeah. So that is alleviating a fair bit of cash requirement. Now, I think the main thing for anyone tuning in is don't just target these states alone just for that. Because remember, a stamp duty is a one-off hit that can be made up in percentages of growth or percentages of income gain. But the stability of the asset, the tenant selection, the location selection, the asset industry type all means more in the long term, right? So we're not playing the stamp duty game. It's more just like having awareness of these stamp duties key. Doesn't mean we're just buying for the purpose of like a grant or a benefit or a gain. And because I think many people don't realize this as well. Yes, we'll make and save money on the upfront cash required, but usually there's been yield suppression occurring in some of these markets to make up that stamp duty waiver. So example, pre-Adelaide or South Australia applying that, stamp duty waiver, they used to have net yields that were much higher. And then as soon as the stamp duty waiver kicked in, the net yield suppressed a little bit because people are just, whatever I wasn't paying here, I'm just going to pay there. So that's something just in generic across like grants and benefits all over Australia. But mate, this has been helpful. A really quick episode to help people out in transition points from residential to commercial, then understanding funds position required. And then from our purchasing points, we prefer to operate in that 1.5 million and above. What are some other things to sign off on just to give people an idea of the minimum things that we need to consider very high level when purchasing a commercial property asset? Things like lease term or other things that you like to look at.
Yeah, so in terms of net returns and lease terms as well, so we like to sit in a ballpark between 5.5% to 7%. The reason why we have that is because we see that range to be the best risk for return profile.
Yeah.
And what I mean by that is, Arjun, anything below 5.5% isn't going to give you a significant cash flow. It isn't going to give you much cash flow, so to speak.
Yeah.
And anything below 5.5%, you're going your Red Roosters, your KFCs, you're going into really like Woolworths, for instance. You're really high quality tenants.
So it has to be like a standout, right? Only for you to consider that. Otherwise, it's like a massive standout.
Yeah, that's right. And anything above 7% is typically high risk. So the asset class or the asset type, maybe it's a retail or if it's an office asset, or it could be an industrial building, right, that requires significant CapEx works or it's got a poor tenant. So we like to sit in that healthy 5.5% to 7% because we're finding good deals that produce a good cash flow, but also give you a really good risk profile too.
Got it. So this is that typical banding, right? And it's like, it's not that deals can't fall on either side for certain reasons. If there's something slightly lower than 5.5 net, but it's got long leases, grade increases, stability, brand name, location, X factors there, then it makes sense. But then if it's got things over 7, but it's a unicorn and we found something that ticks all the boxes, we've seen both occur. I know other things that we consider are lease length. We love to operate in that sort of 2.5 year minimum remaining or longer, just to give that tenants stability for our property commercial investors. And so just these things to consider as everyone's on their commercial journey, from types of deals, prices, cash required, stamp duty waivers, and transitioning from residential to commercial. Chris, that's been really helpful just to give our listeners and watchers a bit of insight into that world and some considerations, especially as, sometimes me and you get carried away with the fun we have in the episodes with our guests and the depths and the details. So it's good to just step back like this and just go through it ahead of time.